Welcome to our third session in our mini-series, Risk-Based Financial Management and Supervision. Our topic today is Proportionate Risk Assessment, the IAA risk tool in action. Please note that for our attendees, you can use the Q&A feature in Zoom if you have any questions during this presentation. We will address the questions throughout the webinar and at the end of the presentation. This session is also being recorded. The recording and the slide deck will be available on the event website later today. I would now like to introduce Fred Rowley. Fred?
Thanks, Christian, and hello, everyone. My name is Fred Rowley, and I'd like to repeat that welcome from Christian to our mini-series on risk-based financial management and supervision. Today's session is the third, and it deals with proportionate risk assessment. And we'll be showing you something of the IAA risk tool in action. This mini-series is, of course, delivered to you by the International Actuarial Association in partnership with A2II, the Access to Insurance Initiative, part of the IAIS. So it's my pleasure to introduce to you the four speakers we have today. Excuse me, the four speakers we have today. And we have two distinguished actuaries and two distinguished insurance supervisors from Africa, both from Uganda. So I'll start with our guests from the insurance supervisors. Firstly, Edith Apu, who's after 3 years as a data analyst in health services, is now working for the Insurance Regulatory Authority in Uganda as an actuarial officer. She's an actuarial science graduate, and she's studying for the Actuarial Risk Management credential, the CERA. We will also welcome Ivan Kilameri, who has 12 years of insurance experience with the Insurance Regulatory Authority in Uganda, and he's the manager at Risk and Actuarial. The most important thing about our two guests from Uganda is that they've both been involved in Ivan leading and Edith spearheading the implementation of risk-based supervision in a proportionate way, which you'll hear a lot more about later. Our two actuarial guests, Nigel Bowman is a distinguished actuary from South Africa who's spent a lot of years working around the region implementing digital solutions for accessible insurance products. And he has a considerable involvement in supervisory matters. He's the chair of the IAA's Microinsurance working group, and he was involved in the development of the risk tool and some of the associated technical papers. As regards a lot of that can also be said about Jules Gribble, our guest from Australia. Also a long career in consultancy, a distinguished career with the IAIS in Basel. He's a holder of the CERA credential, so he knows something about risk management. And he's been involved also in those working papers and in the development of the tool, and in particular with the implementation of it. So without further ado, I'm going to pass back to Nigel, who will begin the first part of our seminar on proportionate risk assessment. Thank you, Nigel.
Great, thank you very much, Fred. Appreciate those really kind introductions. So the first webinar in the series was around the ORSA, which is considered to be the core tool available to risk-based supervision. So if that's the core tool available to risk-based supervision, then any risk-based approach needs to have the ability to identify the key drivers of risk, because that's what a risk-based approach is all about. And today's session that we're talking about the IAA's risk assessment tool and the associated process that has been developed. So I'm going to introduce the tool, a very brief introduction. I've done a few training courses on the tool, which covers 2 days. I'm going to try and fit that material into about 20 minutes. So it's going to be a very quick ride, an introduction through the tool. Jules is then going to take us through 2 example applications, real life applications of how the tool has actually been applied in practice. And then we're going to move to an interview with the Insurance Regulatory Authority, with Ivan and Edith, Insurance Regulatory Authority from Uganda, to understand how they've implemented the tool in their product approval process. Next slide, please, Christian. So in terms of my brief introduction to the tool, I'm going to look first at the objectives of the tool and then have a little bit of a peek into what the tool actually does and how it works. And the next slide again, please, Christian. So the tool was developed, as Fred said, by the IAA's Microinsurance task force, together with a technical paper around with the title of Assessing Risk and Proportionate Actuarial Services in Inclusive Insurance. So it was developed from an inclusive insurance perspective, but it is equally applicable to other insurance contexts, as well as even wider than that. And the tool is an Excel-based tool, which requires the user to simply input a number of the parameters, and the rest of the process is effectively facilitated by the tool itself. And I was also mentioned that the tool was developed in conjunction, basically in a joint project with the IAAS, the International Association of Insurance Supervisors. So there was very much also a supervisory angle to the tool as well. So the key objectives of the tool, I guess, as you've already realized, is really to develop a better understanding of the key drivers of risk, particularly within an insurance context, and also the level of risk that those drivers represent. And through that better understanding, that will lead to better decisions being made relating to risk. And if you're taking better decisions, you're pretty sure to have better outcomes for all stakeholders involved, be it the insurance supervisors, the insurers themselves, policyholders, and other stakeholders such as your distribution channels. Next slide, please, Christian. So the tool effectively provides us with a systematic process, as I've said, to identify your risks, assess the level of those risks, and it also basically facilitates a method of identifying mitigating actions that can be taken to reduce the impact of those risks that have been identified. And I'm going to dive into quite a bit more detail shortly in terms of, and basically try and explain how the tool works. But through this systematic process, you're effectively structuring your thinking around risks, which is highly beneficial. So in a number of the training courses that I've done, introducing that structure to the process of assessing risks is very highly valued by the participants. You're recording your inputs for later adjustment. As you'll see, the process is actually a very iterative process. And by recording those inputs and the justifications that you are taking, or justifications for why you're making certain decisions and assessing risks at a particular level, are very, very important. And that allows you to reference those justifications in the documentation in future. So if any of you have ever had to justify a particular decision relating to risk 6-12 months after the decision's been taken, you'll know how valuable those records actually are. So the tool itself provides an output, a particular level of risk that you have assessed, but that is not the end of the process itself. You take that greater understanding that you've developed of the risks that you are assessing, as well as the outcome, and that feeds into a broader decision-making process. And a really good example of that is if you are assessing a particular new product, the risks within a particular new product, the decision that you're taking would probably be something related to whether the product can be launched or whether it is too risky and you need to go back and revise some of the product features, for example. Next slide, please, Christian. So how does the tool work? This is quite a busy slide, and it serves as essentially as an introduction to the process, and then I'll start unpacking the various steps in the process as I go along. But essentially, we're looking at assessing the risk in a particular product. We're assessing the risks that arise from the insurance company that's providing the product, and we are combining those two assessments into an overall level of risk assessment. The combination of those two levels, the product and what's known as the provider risk, happens through a heat map, which is essentially that 4x4 matrix with all the pretty colors in it. Fitted on that matrix is your risk appetite. So effectively the level of risk that you are willing to accept and the point at which you become uncomfortable with the level of risk. And then there's an iterative process of going back, looking at the key drivers of risk, those elements of the product or the insurance company that are giving rise to the greatest level of risk, allowing you to identify what mitigating actions can be taken to reduce those residual risks within those different categories. And you can continue that process until you're comfortable that you've got a reasonable level of risk, and you can move on to taking that business decision, as I've mentioned. Next slide, please. So I've mentioned that we look particularly at product risks and provider risks, or the risks coming from the insurer. So product risks are essentially those risks that are driven by the features of the product. They're typically technical in nature or actuarial in nature, relating more to the prudential aspects of a product. And examples of that may be a lack of pricing data, which is very common in a lot of the developing markets, or an excessive exposure to large claims, for example. On the second dimension, we look at the provider risks, which really relate to the ability of the insurance provider to develop an appropriate product for the target market, deliver that product appropriately to the chosen target market, and then to maintain and manage that product going forward. So these relate mostly to operational issues. And examples of these kinds of risks would be a lack of internal controls and a lack of specific skills relating to, for example, that kind of product. So the thinking here is that let's take, for example, a really simple credit life product, which on terms of product risks would typically score very low. So on the vertical axis, it would be down towards the bottom. So in the green area of risk. If that product was put out by an insurance company that is very well governed, managed, has the right skills, etc., the risk from the insurer's side would also be very low. So you'd be really sitting at the bottom left-hand corner of that graph. But if that same product, that same low-risk product, was put out by an insurance company that had very poor governance, very poor controls, didn't really have a handle on the experience that that comes through under the product, and really can't monitor what's going on, that insurer would be essentially a high-risk insurer. And the combination of a low-risk product and a high-risk insurer would push you along the horizontal axis into sort of the yellow, orange, and possibly even the reds. So it's really the combination of the risks that are coming out of the product features, as well as the insurance company that's providing the product, that results in the overall level of risk. Next slide, please, Christian. So how do you go about assessing what is the level of risk on the product dimension and what is the level of risk on the provider dimension? So the simple table that I've got up here is essentially what the spreadsheet does. There are, within product and within provider, there are a number of risk categories, and the example that I've got on the screen really just shows 3 examples of those risk categories under the product dimension. So the sum insured, data and fraud, potential. So the first step in determining what the level of product risk is, for example, would be to set the risk weights. So the risk weights are represent the relative importance of each of those risk categories. So they will then be used to calculate a weighted average of your assessment of the level of residual risk under each of those risk categories. So the tool facilitates this process where you can simply choose for each risk category what your relative weight would be, and that can be low, moderate, medium, or high. Each of those weights are assigned a value from 1 to 4, and that's used to then calculate the relative weighting. These gray columns are hidden, you won't see them in the tool. The second step is then in determining your risk score. So this is where you make a judgment call in terms of what is the actual level of residual risk, the risk remaining within that risk category. The examples here are that you have a sum insured risk score of 3, which would be a moderate level of risk. And the risk scores can be chosen from 1 up to 4, 1 representing low, 4 representing high. And we've specifically chosen to have 4 categories so that you do not have, for example, if you had a scale from 1 to 5, you could essentially sit on the fence and choose the middle score of a 3. So you're forced to make a judgment call of whether risk is a little bit above or a little bit below average, a 2 or 3, or a 1 or a 4, really low or high. Once you've done the risk scores, we then calculate the weighted average to get to your total risk score for your product assessment and for your provider assessment. Next slide, please, Christian. Okay, can you click through? Thank you. So the next step then becomes to actually combine your product risk and your provider risk into an overall risk score. So the question is, how do you do that? Next click, please, Christian. The first step here is to basically map those decimal scores, which would come out, the weighted risk scores, into, again, 4 different levels of risk. Can be considered to be a green risk, which represents your low level, where you are comfortable with the levels of risk. And as you move up towards the red, you basically taking the decimal score and mapping it to those 4 different levels. So on the left-hand side, there's again an example of the parameters that can be set to map your 3.2 into a low, moderate, medium, or high risk. And in the example that we've got here, the 3.2 exceeds the 3, which is the boundary to push into the high risk, which is essentially a no-go zone for the product side. Next click, please. So you perform that, well, the tool effectively facilitates that process for you on both the product and the provider risk. And then you can essentially map that level of risk coming out of your product and provider onto your 4x4 matrix or your heat map. So in this example, product risk assessment came out as a high risk, which is represented by the top row in the matrix. So the product risk going essentially representing rows, provider risk being represented by the columns. The provider, the 2.4, came out at essentially an orange, the medium level of risk, which would then be the 3rd column from the left. So at the intersection of your product risk and your provider risk scores is essentially where you land in terms of your overall score. So the heat map is used to combine the 2 different scores coming out. And the implication of this is that you need to, before you do your assessment, define your heat map. And the heat map is essentially a representation of what each combination of product risk and provider risk results in terms of an overall risk. So if you were to take, for example, let's take the top left cell in the heat map matrix. That would represent the combination of a high product risk and a low provider risk, which you'll see is combined into a yellow cell, which overall represents a moderate risk. So a combination of a high product, low provider combines into a moderate level of risk. And you also need to set your risk appetite up front before you begin your assessment to make sure that you're not tempted to retrospectively fit your risk appetite to ensure that your outcome from your assessment is within your risk appetite. Next slide, please, Christian. Thank you. So now that you've gone through the process once and you have your overall assessment, which in this example is high, it's sitting in one of the red squares, you can now go back and start identifying those, what were the key drivers of risk, which are those risk categories that we've assessed are contributing the most to either the product risk score or the total provider risk score. And next click, please, Christian. And that you can see very simply in the tool again by taking those those three risk categories that I had spoken about. And you can see the weighted risk scores from 1.2, 0.4, 1.6, adding up to your total score. So yeah, you can very easily see that fraud potential was the main driver of risk. And you could, for example, go and look at what mitigating actions could be taken to reduce fraud potential, maybe bringing in additional skills who are really skilled in fraud detection in this particular product, which could end up reducing your total product risk score from, let's say, for example, a 3.2 to a 2.8, which would push you down into the next level of risk. You can do something similar on the provider side. Click again, please. With the overall result then, if your product shifted down one level, so from row 4 to row 3, and your provider shifted left one level from a column 3 to a column 2, you can see that overall your risk may shift from something high to what's effectively a moderate risk. So the intention here is to effectively iterate through the process so that you are shifting from the top left corner towards the, top right corner, apologies, towards the bottom left. So you're shifting from the red towards the green. Next click, please, Christian. And that process you can effectively repeat as many times as you would like. So you can go and identify what are the key drivers, what are the mitigating actions you can take for those key drivers, and then assess what is the impact on the residual risk for that particular risk category for which you're implementing the mitigating action, and see what impact that is on your overall risk assessment, and repeat that as many times as required. Next slide, please, Christian. So that was a really quick introduction to, I guess, the mechanics of how the tool works. Jules will speak a little bit more to that. And there'll be time for some questions and answers, but to just try and pull it together a little bit, I'm going to quickly run through the end-to-end process now. So the first step in the process is effectively to define that heat map. So what each combination of product risk and provider risk results in terms of an overall risk, and defining your risk appetite, or setting your risk appetite, at what level will you become uncomfortable with the level of risk that you're taking on. You then go and complete your product and your provider risks by setting the relative risk weights, the importance of risks, and then you actually go and assess the level of residual risk within each category. That is then combined into an overall risk rating, in step 4 compared to your risk appetite in step 5. If the overall outcome is not within your risk appetite, and even if it is, you probably would want to go back and look at what risk mitigating actions you can take on the main drivers of risk, and then reassess those risks in terms of how has the residual risk reduced. And again, you combine an overall risk rating, you test against your risk appetite, and when comfortable, you take that increased understanding as well as the overall outcome. But really important, you've gained a much better and deeper understanding of what is driving the risks through this process. You take that into your into your decision-making process. So for example, as a supervisor, should I be approving this product for launch in the market, where there is a formal product approval process that's required? Or should I send it back to the insurance company to look at some of the risks and try and reduce some of the risks that have been identified? The next slide, please, Christian. Okay, so as I said, I realized that has been a very quick tour through the tool and the process. So on the IAA's website, both the paper and the Excel-based tool is available together with a few worked examples in the tool. I would certainly encourage you to go and have a look at the website, access the tool. And if you have any questions, we're going to have a little bit of time now for questions and answers. We can maybe take one question before we move on to Jules. And there'll be time for questions towards the end of the talk as well. So thank you very much. I hope you have managed to follow that.
Nigel, we do have a question that's come in. The question is, how can an insurer determine its risk appetite when entering a new market?
Okay, excellent question. So yeah, risk appetites, I think, are obviously very subjective, and you need to work through the, I guess, engaging with your various stakeholders in terms of what their level of risk appetite is. So yeah, I almost want to say, let's maybe hold this over until this question over until Jules has done his bit of the talk as well, and then we can maybe come back to it if you are comfortable with that.
Okay.
Thank you. Jules, would you like to go, please?
Yes, thank you, and thanks everybody for taking the time to listen to us. I don't know whether it's morning or afternoon or evening. I think because you move around the globe, it's in varying places. I'd just like, Christian, can we start on the first slide, please? Yeah, that's good. That's the one I want, even better. That has the picture in the upper right-hand corner. It had, now it still has. I'd just like to make a couple of comments, if I may, at a general level, because what Nigel has described in his little whirlwind tour is a management tool. It's a management tool for insurers to deal with their products, and it's a management tool for supervisors if they're reviewing insurers. And it's because it's put down things explicitly and it's documented them. And that means retrospectively, you can look and see whether you achieve the changes you assumed would be achieved to reduce residual risks on the one hand, and prospectively, you can use it to determine what changes you might need to have made in order to progress into the next year or the next reporting cycle. So that's the first point, is to use it as a management tool. Second point is that what we're doing here is we're taking a collection of little risks, if you like, each of the criteria that you might use to assess product or provider risk, and we're managing a portfolio of risks. We're putting them together so that they have an aggregate behavior, a single aggregate behavior, as opposed to lots of individual behaviors. And the easy analogy of that is that if the duck is sailing serenely across the top of the water, that's the aggregate. And what the legs are doing underneath the duck, which might be all sorts of things, those are what the little individual risks do. And we know that portfolios of risks behave differently than their individual drivers. So think of this as an aggregation process. And the last point I want to make is this is a general process. We're explaining it to you in the context of product and provider risks in order to do product assessments, but the approach and the process is quite general. We had lots of numbers there, and I'll just to share with you how I think of the different coloured squares. Notice we only have 4 colours of squares. We're only giving ourselves 4 levels of risk which we can assess them at. And they are green, which is I'm happy, is how I think of it. They're yellow, which means I'm okay. It's not perfect, but I'm okay. And then it comes to orange, and that says I'm concerned. All right, things are not great here. And it comes to red, and red is I'm not happy. And if you think about your assessments of the risks, be they individual or in aggregate, in those terms, firstly, it makes it a general process, and secondly, it starts potentially being able to inform where you might put your risk appetite, the blue line in that particular picture there. So I've got a fairly blunt tool in terms of only having 4 levels of risk I'm allowing myself. It's a management tool, and it's a risk aggregation, a management of risk portfolio tools. So just to summarize what Nigel outlined beforehand, you set up all your parameters, that's the risk matrices and the risk appetites and so on, before you do anything else. You then set up the set of criteria you're going to use to assess each of the dimensions. That's the one coming in from the left or the one coming in from the top around the matrix. So you set your questions next. Then you actually apply it, see what answer you get, but you've got all the mechanics set up. And you review the outcomes to see whether you're happy or not. And in terms of looking at the risk matrix, if you end up in a red cell, you're not happy. If you end up in a green cell, you are happy. And you may or may not revise things. But what you can do is you can take the output from that assessment, which is the purpley arrow going from the yellow cell up to the right-hand side, and you can take that forward into another version of the assessment process. It just becomes the input to the next part of the process. And we'll bear that in mind because we'll come back to that later quite specifically. So I want to talk a little bit about the process for doing product and provider dimensions, picking up from what Nigel said. And then I want to take it and expand the process, show you how to use that box in the upper right as a building block to build more complex assessments. So can we have the next slide, please? Next. No? Yes, sorry. So here we have just 2 dimensions, as I said, and what I've made it clear here is that this is the supervisor reviewing the product. So presumably the supervisor is going to review the insurer's assessment and see if they agree or not. If they do, that's fine. If they don't, you have a language for discussion, so it enhances the interaction. I will make the point this always requires professional judgment, right? You can't just simply apply the tool, say the answer is 2.2 and you're done. And what it also does is it clarifies questions, as in which changes do you want to have made and so on. It doesn't give you answers. It codifies and structures the process for you. The other point I'd bring out here is in terms of access to this. If you think about the 4 levels of risk you can have about, as I was saying, being happy, being comfortable, being concerned, and being not happy, a lot of people can input to that in terms of having a discussion around the table without worrying about the mechanics of the numbers. So it's quite an inclusive process, both from a technical point of view of technical people and those who have experience to share. So that's all right. And as I said, it's only part of the story, but we'll see that in the second example. So next slide, please. So what I've done here is I've actually listed off at a high level the set of criteria, of which there are 8 plus the line at the bottom, which is and anything else that the supervisor hasn't thought of, given we're doing supervisory approval. These are the 8 high-level criteria that are used to do the product assessment. They're pretty basically traditional actuarial stuff focused on product pricing. I'm not interested here in going through them in detail. I just want you to have a look at the list and to make the point that for a particular product or a particular company or a particular circumstance, the last category down there provides you with flexibility so you can add other things in. You could add in more than one line if you so chose. It's just the other stuff is all in there together. So I've got a flexible set of questions, each of which you can think of as a particular little risk, and I'm going to aggregate up the answer to get a total, an aggregate outcome for the product dimension going in. Next, please. In exactly the same way, although the format's a little bit different, I've got 6 key areas to assess from the point of view of the provider being able to properly provide the product in the end, which are basically all operational risks with the one exception of the technical insurance management, which is the actuarial and the financial stuff. All the other bits are operational. And at the end of it, there's the and any other factors, supervisor to decide depending on the product. So again, I retain flexibility, but I have a structure which I can use. And each time I make decisions about each of these little sub-risks, I document why I got to where I got to. It's not a matter of being right or wrong. It's a matter of saying at the time we made this assessment, this is what we felt was and the appropriate, and here is why. So again, when we finish this part of the process, you will end up with a single aggregate result which reflects the provider risk, and those were the things that that and the product one were the things that Nigel was discussing when we looked at the previous pictures. Next, please. So we just have this gives you the process. Now, so that gets to our part of we've assessed the individual risks. Now what we have to do is you have to decide which ones are the important ones. So we decide on the risk weight, which is the importance of the risk. So it's really highly important, medium, moderate, low, or not relevant. And those are also quantified as 43210. It's a coincidence, I should add, that we've used a scale of 1 to 4 for the risk weight, and we've used the same scale for assessing the level of risk. No reason why you have to do that, except you don't want to get too complicated. So that's important. That's what counts and what doesn't count. Then, from the point of view of how well you're managing each of those risks, independent of how important it is, the question is, are you, in terms of the residual risk, are you still at high risk, which means you're not doing a good job? Or are you medium risk, moderate risk, down to low risk? I think probably realistically, the only time you put in no risk is when you're not doing it, because risk doesn't go away. So now you've said how well managed is the risk, and the lower the score that you of that 4-3-2-1 rank that you use, the better off you are. There's 2 comments at the end, which are when we've got the risk weights. Remember, those are the things about how important. We just do a scaling process so that the risk weights add up to 100%. Otherwise, you can sort of end up with numbers that are too big in the process. So it's simply a scaling process to make sure everything is included proportionate to the risk weights you've assigned. And you document everything because, as Nigel said, in 6 months' time, you're not going to remember why you did it, and you need to be able to come back and review it in a constructive way so that when you look at experience from a year on, you can go, well, we got this right, or we got that right, or we got that wrong, or whatever it turns out to be. So that's the assessing of each criteria. Next, please. So now you've now got each of your criteria assessed, and you have to do the aggregation to get to a single outcome for the particular dimension you're looking at. In this example, product or provider. And you essentially just take the weighted average of the risk weight percentage. Remember, that was the bit to scale it to 100%, and the risk score. And that'll get you a number between 1 and 4. from a numerical point of view. And I've listed down just in that particular example how it might work for those particular dimension scores. If you in aggregate came out less than 1.5 in this case, you're happy. It's green, you're very happy. If on the other hand, it came out bigger than 3, you're not happy. It's a problem, so you're red. Those dimension scores, the 1.5, 2.25, 3, that are in that left-hand column, those are input parameters that you decide on beforehand. And depending on the particular risk or the particular product, you might, for example, decide that you're only going to be unhappy if the, as in have a dimension outcome of 4, if the dimension score is bigger than 3.5, let's say, if you're feeling brave. Okay, but the point is that these bits here, the dimension scores are parameters that you set, so they're part of the process. All right, next slide, please. And here I've just tried to summarize it and make a couple of points as well. So firstly, you've got different dimension scores. So the input from dimension 1 is you're okay. That's the yellow box on the left. And from dimension 2, you're not happy because it's red. And if you look in the upper left, you'll see that the boundaries between happy, comfortable, not comfortable, and unhappy are different. So in this particular case, you've chosen different parameters to reflect the characteristics of the different dimensions. It's coincidental that in the prior examples that these things were the same or were symmetric. The other point to note is that the matrix in the bottom right, is not symmetric in terms of the colors of boxes, and there's no reason why it has to be. This one has a bias, if you like, toward dimension 2, where dimension 2 is performing badly, so like the red box, that has a strong impact. Sorry, hang on, got some feedback, which has gone away. And I've made the boxes in that picture, in the matrix, to reflect the size, the numerical size of the dimension score. So the boxes are of different sizes. So visually, there's quite a lot more green in there than there would have been if all the boxes had been the same size, which is perhaps a better reflection. And the last point to bring in here is that all the parameters, so which are the colors of the boxes in the matrix, and the risk appetite, which in this context is the blue line zigzagging through it, and the dimension, the boundaries of dimension scores, those all should be chosen to reflect the specific situation you're looking at. They're not set in stone. So don't forget to review them as you go along. Okay, let me go to the next one now, if I may. That's the end of that first example. And this is the second example, which will illustrate some other points here. And firstly, it's third-party motor insurance. NTPL is the abbreviation used. This is based on an actual retrospective analysis done by a colleague and I in a particular country. And this is interesting. The political decision was made to have compulsory coverage. So from a supervisory point of view and an industry point of view, that's a decision that was imposed. And you just have to work with it. The second thing is that everybody recognizes, the supervisor and the industry recognize they're not fully prepared. So basically they're probably already orange or red all over the place. And they need to have a sustainable market and they need to manage it. So this is an imposed problem. The question isn't, are we going to approve it or not? The question is, how are we going to manage a situation that's not perfect? And this tool was applied, and what it did was, because it's structured and made explicit decisions, it was able to clarify where, firstly, the key issues were, and secondly, therefore, lead to how they may be addressed in a much more specific manner than just throwing up their hands in horror. Okay, so next slide, please. Now, just bear with me on this one. The key thing here is to observe where the little colorful matrices are. So on the bottom, you've got where it talks about supervisory view of business risk assessment. This is what we've been talking about so far, with one matrix, a product assessment and a provider assessment. Remember, I said the output from that can feed into another matrix, and it does. It feeds into the one on the upper left, in the column on the upper left. On the other hand, we've now applied the process more broadly, and within the supervisory risk assessment, some other assessments are done and by the supervisor. So what the supervisor in this context did was what we called a marketplace risk assessment. This is the one up, second from the bottom. It had two components. The first component, first dimension in that was how capable are the consumers? Like, have they got a clue or not? And are they interested? And things like that. So that's the market, external market for the product. The second element of that marketplace risk assessment was the supervisor's view of its own capability to address this product style in the market. So that gave you two dimensions. You pop them into major assessment, you pop them into a matrix, second one from the bottom, and it produced an outcome that went up to the market risk assessment one. And that was an input to the next level matrix. Okay, because the marketplace assessment goes to the column on the left of the box that's third up from the bottom. And then specifically, because this was in an actuarial and a prudential context, the supervisor made an assessment of their actuarial capability. None of the rest of it, just the actuarial capability, because this was viewed from a prudential and a financial problem as strongly an actuarial challenge. And that provided the second dimension of that supervisory risk assessment, which is the bit, the second row from the top, if you like, looking down. So I've used the process, and then finally, the two bits come together with the supervisory view of the business risk assessment from the bottom, coming up to the column on the left in the top matrix, and the overall supervisory risk assessment, which came into the rows. And that generated the supervisory prudential actuarial risk assessment, which is how happy was the supervisor from a prudential point of view with all these bits that are happening underneath them. And as Nigel has highlighted, that prudential risk assessment feeds into a broader supervisory decision-making process, because there may be other aspects to be considered than the ones that we've considered here. But the key point here is that we have applied the process in a sequential manner 4 times, once for each of these little matrices to get an aggregate piece at the top. Okay, next slide, please. And so in looking at this, here are a number of criteria that can be addressed. So the marketplace is slow to change, it's mandatory cover, all things that are basically problems here. So that gives you some context. And I'll show you where we got to on our initial assessments in the next slide, if I may. So this is a way of what I call cascading upwards the results from the matrix we saw 2 slides ago. So here's our assessment of the business from the prudential point of view, product and provider. These are both orange, which in the risk matrix you use generated an orange outcome. So, you know, we weren't too enthused about the industry's capacity to manage either the provision of the product or design it, but it's not a disaster area. And that's what's reflected here. On the other hand, looking at the work we did from the supervisory side, the first one was the marketplace assessment. And here the consumer capability was ranked pretty poor. That's a problem. And the supervisor's capacity, remembering they weren't prepared, it's not great. But orange and red in the matrix you use generate a red outcome. So now I've got a very not happy answer from this process being propagated up. I put that together with my actuarial capacity, where I've got some, but again, it's not great. And again, a red, a not happy, and a concern generate a supervisory risk assessment of red, not happy. And when I do the final step, red and orange generate red. This is I'm not happy outcome. And that's how I think of it, right? You can put the numbers in here and watch them move, but the key thing is which color do you get? So that's really not a satisfactory outcome. So next slide. We do the iteration and go, what can we do about this? All right, we've got to reduce the assessed prudential risk. So we can exclude, in the short term, we can improve the expertise and resources. And the only way to do that in the immediate is to outsource it from a supervisory point of view. Because you haven't got time to say, we're not going to do this process for 5 years while we build up our capacity. So outsourcing. The second thing that can be done is you get good data. So at least you can know what's going on. And in that context, it was clear that neither the supervisor nor the industry had good data. So this is a longer term process, but you can identify it as something that's clear and you can put in place immediate steps to start it. You can check capital adequacy status of the potential providers because, you know, more capital they've got, the more mistakes they can survive before they go bust. And you can get a sense of their strength by watching the capital levels. You can check the financial strength of the shareholders because the companies may need to get more capital to come in. And you can increase the depth and frequency of reporting. And the point of these things here is these are all specific actions that you can take, which you can drive out of the identified really weak areas in your analysis beforehand. So next slide, please. So if you do that, the slide we had at the beginning, which ended up with a red box here, which was basically not acceptable. On the right-hand side, provide a risk analysis. You can do some work here with the provider's capability of developing and delivering the product. So you might reduce, it's possible you could reduce this from an orange to a red, although in this process we didn't do it because we were focusing more on supervisors. But that's an obvious thing to encourage the insurers to do. On the other hand, over here on the left, this in supervisor capacity box, we've put in place steps by outsourcing and bringing in expertise to move this guy from an orange to a yellow. And that's good because when yellow and red propagate up, they propagate up into the marketplace risk assessment of being orange, not red. It's one level lower. And you may remember that we had an actuarial capacity of orange, and if we do outsourcing and get some expertise in, we can bring that down to a yellow as well. These are all prospective plans, given that the decision's been made, but at least we know how to address them. And that means that you will bring forward, hopefully, a supervisory risk assessment that's now yellow, and yellow is pretty likely to be acceptable. And that means that when you do your final assessment, you have an orange and a yellow, and you get a prudential risk assessment subject to the successful implementation of your remediation steps of yellow, which is probably an acceptable outcome. So this example shows you that what we can do is we can apply the process. This was actually applied retrospectively, but you could equally apply it prospectively because this is what you would do. And retrospectively, when it was applied, there were a couple of aha moments to be had, which were then followed up and things worked out reasonably well. So this gives you an example of how the individual process for combining two dimensions, aggregating two dimensions into a single answer, which is what happens every time you step up, can be done, and how you can use it, well, in this context, use the process and approach as a management tool at the industry level, which is a different level than a specific insurer for a specific product. Maybe the next slide, please. So I thought it's worth just putting down a couple of takeaways. I'm almost going to claim that I've done this presentation, which is an actuarial presentation, but it has no numbers in it. So I just want to get credit for doing an actuarial presentation that doesn't have any numbers in it as well. But more seriously, the risk tool can have more than 2 dimensions. We've talked about 2, but clearly it can have more than that. It's extendable. It can be applied in many situations. We've just seen how it can be applied retrospectively instead of prospectively, and at an industry level as opposed to an individual product level. And it works because it provides a structured, documented, and open process, not a pen process, an open process for risk assessment and review. In short, it's a management tool for both supervisors and insurers. And outcomes from the tool provide inputs to broader decision-making processes. And that's an important part of this, because we need to recognize that doing financial assessments or prudential assessments or actuarial assessments, whilst they're important, there may well be other important criteria that the supervisor needs to bring to bear as well, and their decision-making process will take in the input from our tool, but also inputs from other processes or tools as well. So it's part of a broader game, but it is not the full game. So those are the takeaways I would like you to consider as we go forward. So I'm good now. I think that's the last one. If we do the last one, yeah, we just get a finish slide. So maybe back to you, Fred and Christian. I'm happy to take questions, but how do you want to do this?
Yeah, we do have one question that's come in. It's a 2-part question, so I'll read it out. How do we minimize the subjectivities, A, in assigning weights to the individual risk categories, and B, when awarding scores by an individual assessor? And I'll do the second part later.
Okay, yeah, I'll take that in 2 parts, as you say. In assigning weights to the individual risk categories, I'm sorry, you're going to have to apply professional judgment. There is no magic formula for it. You have to look at it and go, is it important? Yes or no? And you know that you've got your 4 levels of importance, right? Very important, medium important, lower level important. And you have to go up and down the line and go relative to the other criteria. In my judgment, potentially in discussion with your colleagues, you come to a consensus and you decide on the relativities. So yes, you can argue it's subjective because you're applying professional judgment, but on the other hand, there is no objective way of doing this in terms of, is there a formula, strictly speaking? No, there's not. That's why you're paid to be supervisors and do judgments, and in companies, you're paid to occupy the roles and make judgments. When awarding individual scores, I think the answer I would give you there is there are at least 2 things that come to mind. One is from the professional actuarial point of view, is called peer review, and discussing with your manager and so on your process. And the second one is perhaps a more broader view, which is there's no harm in getting together a group of, say, 6 or 8, I know, a relatively small number of people who have a lot of experience to bring to bear, actuarial or not, putting them in a room and getting a consensus. So that will minimize subjectivities and personal foibles. It doesn't take away the fact you're exercising judgment, but there's a lot of experience out there. This sort of, it's called the Delphi method, which I think comes from the Greek, and it means you talk about it a lot. But there's a fair amount of evidence that these sorts of group decisions actually can be quite wise. So that's your second option. Your second question?
Sure.
Christian?
The second question is, how can we objectively resolve a difference in opinion of risk score across different assessors?
Well, I sort of addressed the objectively already. The simple way of doing it is when you have a number of assessors, so a number of opinions, you take the average. That's your crowd-funded, crowd-sourced answer. If the average is not appropriate because some people should have a higher weight than others in doing it, you take a weighted average. Ideally, you would come to a consensus. But I think if you have widely divergent views, then there are some seriously different concepts at work in the background. If you've got close views, you know, there's always room for some level of disagreement, but taking an average or having the chair of the meeting make the call because they're the most senior person present, whatever, you put in place a mechanism for making a decision, basically. And you document it, and you know, if there is an averaging of process or someone has the final word, you note it down. You document the situation in a fair way, because this is not about assigning blame or you know, I said, you said later. It would simply be, there was a divergence of opinion. There were, I don't know, 4 people who voted for or felt the risk level was 2, and there were 3 people who voted the risk level was 3. The chair of the meeting, as the most senior person present, decided that 2 was appropriate, or 3 if that's the way they decided to go. So as I did mention beforehand, you know, some of this is a process about identifying issues, asking questions, documenting the process. It's not the case that this will give you, quote, a right answer. What it will do is it'll give you better, clearer answers, and you'll have a basis to build on when you come back in some time later, a year, or if you're an insurer, or a couple of years if you're a supervisor, and you go around the control cycle process and you review what happened in light of the decisions you took and the experience that emerged. So if you were doing that, and we'd done this process 2 years ago, and we had COVID come along, which we have, we might find we were quite a long way away from what we expected 2 years ago, but that's how life works. And you take that experience and you move on.
Right.
Nigel.
Okay. Yeah.
Thanks,
Jules. Yeah, I think that's good. A brief pause there, but I think we can move on to the next section now, which is essentially a video, a pre-recorded video of questions and answers, together with Edith and Ivan, around their experiences of actually implementing the risk assessment tool into their formal product approval process as the IRA in Uganda. And yeah, we're very fortunate to have both Ivan and Edith on the call today. So yeah, please keep your questions, and you can send them in, and we can answer those questions after we've played the video. Thanks, Christian.
Ivan and Edith, can you please give us a very brief overview of the Ugandan insurance market and the role that the IRA plays in that market to set the context within which you began using the risk assessment tool?
Thank you very much. The Insurance Regulatory Authority of Uganda is a government agency whose main mandate is to regulate and supervise the insurance sector. Along that key mandate goes the key aspect of ensuring that we protect the interests of policyholders. We license quite a number of insurance players. We have 2 reinsurers, 30 insurance companies within the market. We also have over 2,500 agents, 27 loss assessors, 37 insurance brokers, and a number of bank assurance agents that we license. We do license for purposes of protecting the policyholders. Still, we also do ensure that all the products that are sold on the insurance market are approved by the authority. and which really sets the context for us to use the risk assessment tool. So all products that are submitted to the authority must be approved by the insurance regulatory authority after ensuring that they have been reviewed internally, with the main purpose of ensuring that these products here are fair to the policyholders who are going to take them up.
Wow, that's quite a number of entities that the IRA supervises, which means you must receive quite a lot of product approval applications every year. Can you please explain how your product approval process used to work before you adopted the risk assessment tool, and what were some of the challenges that you were facing at the time?
Yes, basically we would, in the past, we would still receive the products, because our main mandate, as specified in the Insurance Act, is to ensure that we protect the interests of policyholders. So we would receive these products and then pass them on to different specialties within the IRA, which is the regulator. So some of these specialists would be specialists in life insurance business, specialists in general, health, as well as the actuarial and the legal specialists. So these specialists would take time and review these products, and then based on their knowledge and areas of specialization, would then make comments, which comments would now be either sent back to the companies, and then before these products are approved. So that's the way we were reviewing and approving these products. It was that kind of process. The main challenge with that process is that it was not standardized and structured. So much as we were doing the best we could to ensure that the products are approved, we realized that the lack of a structured process and standardized process meant that the process was a bit subjective, which then would affect the outcome of the product approval process. So that's the main challenge we had until we then went for a more structured process of having the risk assessment tool.
Thank you. So how did you go about adapting the old product approval process to incorporate the risk assessment tool and bring about that standardization that you're looking for? And can you please explain how the new product approval process works?
Thank you so much. Ideally, a training was organized by Financial Sector Deepening Uganda, and through that training, the technical experts from SEMFRI took the IRA staff through the proportionate risk assessment tool for product approval. And ideally, through that training, we were taken through how the risk assessment tool works. And ideally, the risk assessment tool helps to enable a team identify primary risk drivers inherent in a product, and also to help the team identify some mitigating actions that can enable a systematic rollout of this product. And ideally, the risk assessment tool focuses on a number of aspects, and these are the team that is set aside is to set a risk appetite, and this risk appetite is basically just to guide on what they deem to be acceptable as a team on their side. And then also an assessment of the product itself is done. And on this product side, what you're looking at is the design of the product, the methodology that has been used for pricing the product, availability of data that has been used for some analysis, and also you look at things to do with reserving aspects, and also if the clientele or the insurance industry could be well aware of this kind of product. So you then look at the importance of some of those risk drivers and also their risk score. Secondly, you also do a provider assessment, and by the provider we mean the insurance company. And what we focus on here is if the insurance company has the technical capacity to roll out this product. Have they got the technical skills? Do their customer service team know very well about the product, and do they sell it to the best of their ability? So those are some of the things that you look at for the provider assessment. And ideally, after looking at those two parameters, that's the product and provider aspect, you then come up with a risk score that you compare to your set risk appetite. And ideally, if there is some risk exposures that you feel disable approval of this product, you can also come up with some mitigating actions that can then enable you to be able to accept approval of this product. So after looking at that risk score and look at all the mitigating actions, you then come up with a business decision, either to approve the product or not to approve the product. So after going through the process that is embedded in this tool, the team then agreed that a product approval committee be formed that consists of legal officers, consists of an actuarial expert from the actuarial team, some non-life insurance officers, life insurance officers, and representatives from the market research and development department. So ideally, this means that for every new product that is submitted to the authority, the product approval committee would use this risk assessment tool to assess this product and then to agree on if they will approve the product or not. So this is how the product approval risk assessment tool works and how it will exactly be administered within the authority.
That's quite a number of changes. So what are some of the positive impacts from bringing the risk assessment tool into the product approval process?
First and foremost, it's important to thank the financial sector deepening Uganda for having facilitated this project through which the training was conducted, because now we have a tool that is very systematic, that is structured, that now we use, and this has eliminated to a larger extent the subjectivity that was inherent in our product approval process. So that has been very beneficial to the team. And also remember that now a directive has been sent out to the insurance companies to also submit this risk assessment tool for all their product approval requirements or applications. So this means that this definitely protects the policyholder, because the product has to go through the sieving of this risk assessment tool. You look at the design of the product, if the product is good enough in terms of if the insurance industry is well aware about what exactly is being sold, and also in terms of the technical aspects of the product, if they are sufficient, and also the capability of the provider, that's the insurance company. So this definitely is beneficial from both the insurer side and also on the IRA side. So we are very grateful, and this also will definitely go ahead in helping us to fulfill our mandate of protecting the interests of the policyholders.
Thanks. Those are some great benefits. So what were the challenges that you had to face when implementing the risk assessment tool in your product approval process? And how did you overcome those challenges? And are there any improvements that you would still like to make to the tool or the process itself?
Thank you. The main challenge that we experienced while implementing this risk assessment tool was the issue of lack of industry capacity to implement. And good enough, once we realized that we had this challenge, we then developed solutions around how do we then build capacity for the insurance sector to implement the new and much improved risk assessment tool. So basically what happened is that one, as a regulator, there was a training that was undertaken for the insurance regulatory staff, but still undertaken by the consultants, same free. under the support of FSDU. So capacity was first developed for the regulator, and thereafter there was also the need to build capacity for the industry, because the industry, as explained by my colleague, that the industry also supposed to submit this risk assessment tool. So there was a training of trainers session that was undertaken at the Insurance Training College in Uganda, and a number of trainers were identified and participated in this training. So as an industry, we've developed capacity to ensure that we utilize this tool even in the future. So the trainings have been done for the industry players, as well as the training of trainers and the insurance regulatory authority staff.
Ivan, do you have any further improvements that you would like to make to the tool or the product approval process?
Yes, indeed. We've had a number of engagements with the SEMFRI team, and we've agreed that on this risk assessment tool, currently we are using basically two dimensions, the product risk assessment and the provider risk assessment. We've engaged SEMFRI, and we want to add the supervisory capabilities dimension, whereby we assess the capability of the supervisor, the regulator, in terms of our skill set and our experience in reviewing these products, as well as also ensuring that the consumer capability is also added as a dimension to the risk assessment tool. Now, the consumer capability would basically focus on issues to do with do the consumers understand these products, how literate are they in terms of insurance awareness, and some of these key aspects around the consumer who is going to undertake, the level of knowledge, and these are some of the key aspects we want to add onto the risk assessment tool. We think that once we have these additional dimensions, then we'll have a more robust risk assessment tool. But there's still work in progress that's being undertaken. So we will ensure that going forward, we will have a better tool and be able to protect the interests of the policyholders as we move forward.
Fantastic. Thank you very much, Ivan and Edith, for sharing those excellent insights and experiences. What I take from your answers is the IRA has greatly benefited on two counts. Firstly, by introducing a structured and standardized approach to your product approval process. And secondly, by requiring industry to also complete the risk assessment tool, which then provides you as the supervisor and the insurers with a common language when dealing with any differences. I think those are some fantastic outcomes. Thank you very much once again. It's much appreciated.
Great, thanks Christian for playing that video. Any questions for Ivan and Edith around their experiences relating to the implementation of the risk assessment tool in their formal product approval process? I haven't seen any questions come in, so while we wait for people to ask questions, maybe just one from myself, Ivan, Edith, to pick up on the point of subjectivity that someone has already asked, that Jules addressed in quite a bit of detail. But I know that was something that we spoke at a fair bit of length about, and my opinion on that was that there's actually a lot of strength in diversity, because risk is subjective by its nature. Different people are going to have different opinions on risk. So, which is one of the reasons why your product approval committee has a number of different members in it with divergent risks. But can you maybe explain just how the process works and how you deal with the subjectivity? I don't know whether that's for Edith, whether you will answer, or whether Ivan will answer that.
Thank you, Nigel. And I think my colleague Edith can also answer. Basically, on the product approval committee, we have a number of specialists in different areas. And it's quite important to have the different views from the different members who form the committee. However, where we have differences in opinion, we first of all take time to understand. We discuss these differences in opinion. And you'd find that at times that some of the opinions are key. Maybe there could be something that one of the members of the committee may be underlooked while the other thought it's quite important. So what we did agree is that in the event that there are differences in opinion, then instead of having, say, an average, we could have the specialist's opinion taking precedence. So that could be that's one of the ways we try to resolve some of the divergent views around the risk assessment process. I don't know if Edith has anything to add on.
Yes, remember, maybe just to emphasize, remember that we require for some of the specialists in the product approval committee to actually use this risk assessment tool, make the assessment by themselves. And then we compare the result during our product approval committee meetings. And during that review is when we are able to see the divergent views, but each of the members who have used this risk assessment tool have got to have backup reasons for why their views are that way. So during that discussion is when now we have a final conclusion where then maybe the specialist's view may take precedent, or we agree, you know, on something that can work. And remember, we also take minutes for this product approval committee meetings. So through those minutes, we are able to backtrack and see the decisions that were made. And this also helps to have documentation for any future reference purposes. So yes, the subjectivity might be there, but it's managed through those extensive group discussions. Thank you.
Great. Thanks, Edith. Thanks, Ivan. Yeah, that does sound like I think a very sound and good approach to take. Christian, I don't see any further questions that have come through.
We don't have any other questions at this time, but encourage participants to submit them if they do have any questions.
Absolutely, thanks. So maybe again, while we're waiting for questions to come through, if I can maybe ask another question. That Jules, I'll pick on you this time if you don't mind. So we've heard from Ivan and Edith that they've actually had industry trained up on using the tool, and they actually require industry to submit or an insurer to submit their own assessment of the new product using the tool, which is essentially the same tool that the IRA then uses to assess as well. So they get the industry view, the insurer's view, and their own view, which they can compare. What do you think is the strength of that process?
I think there are a couple of strengths of that process. The first, and perhaps the most important, is that by having both sides of the coin, the supervisory side and the insurer side, using the same tool with the same set of instructions, if you like, you get a common language. So just as Edith pointed out that, you know, when they have their committee within the IRA debating different perspectives, you set the ground rules for having exactly the same debate between the IRA and the insurers. So you get common language, you will develop a common experience out of doing that, out of just doing it and moving forward. And I think also it gives the supervisor an opportunity to synthesize varying views, because there always will be, coming in from industry about particular product types. The supervisor will see all those, and it gives them a mechanism to feed back to industry preferred paths, to trying to find the polite way of doing it, or you can pick out bad behavior and deal with it. So I think it's powerful for the language, and I think it's powerful for educating industry is far too strong a word, but it is a role that supervisors can play, which is helping industry develop. And if you have a development objective as part of your supervisory mandate. This becomes a very powerful tool for doing that. And I think Ivan mentioned picking up some of the other dimensions which seem similar to the stuff I talked about in the NTP example, not necessarily in that exact structure, I might add, because I can see a range of ways of doing it, which would be interesting to discuss. But you have the opportunity to get a deeper and broader understanding of what's going on, and you get some direction capacity for the industry. So I think it's a very, very powerful thing to do.
Great, thank you very much, Jules. Yeah.
Yeah, Nigel, we do have some questions now.
Okay, go ahead.
Would you like to? Okay. So how long did the whole process take from the time the regulator decided to use the tool to insurers using the tool as part of the approval process? Edith, you wanted to answer that one?
Yes. Ideally, a training was held through SEMFRI to the IRA staff in December 2019. So after that training is when we appreciated what the tool does. And then in early February, that's 2 months later, training of trainers was held still by SEMFRI and IRA staff and the Insurance Training College to bring a wider number of specialists to enable them understand what the tool is all about. And then after that training of trainers training, we then conducted a training for the insurance industry players on still this risk assessment tool. This was around the end of February. And after that training to the insurance industry, we then, as the IRA, issued a directive around the month of March, requiring that for all new product approvals, we will require that the insurance companies conduct a risk assessment using the risk assessment tool. And that definitely means that from end of March going forward, we then began using the tool for all our product approval processes, as well as the industry also using the same tool. So that means it took about 4 months for the entire process to be kick-started. However, it now depends on any other regulator or entity that wants to use it. You may have a shorter time or a longer time, depending on how many stakeholders you need to consult and who you need to bring on board, how the trainings need to be done. But precisely for us, it took about 4 months for the entire process to be concluded and for the tool to commence to be used. Thank you. Maybe Ivan, if you would like to add anything else.
No, I think that's fine. That's the period we took. It depends also on the, like Edith has mentioned, on the skill set and the capabilities of different jurisdictions. So you find that maybe for Uganda it took the 4 months, but you might find that in a different country it may take shorter, depending on the capabilities within the regulator and within the industry. If you have actuarial skills, then it will be a bit faster to adopt the tool. Thank you.
Okay, our next question. How many other regulators have adopted the tool under discussion? Nigel, you wanted to address that one?
Yeah, thanks. So as far as I'm aware, no, there are no other regulators that have yet adopted it. I am aware of discussions with one other regulator to potentially adopt the tool. But I'm certainly hoping that based on the experiences that the IRA's had, the very positive experiences, that there will be other regulators and supervisors who would like to adopt the tool, and feel free to contact me if that is the case. And there are potentially ways of organizing various trainings and things to help implementation. So we can discuss those ways and means of doing things if you are interested. Christian, I see we are pretty much out of time, so shall we hand over to Fred to wrap up?
Yes, certainly, Fred.
Well, Thanks, Nigel. There's nothing more to me to do but to thank all of our participants, Ivan and Edith, for a really fascinating description of the implementation of this tool, and particularly drawing out the benefits in terms of it supporting the decision-making process and indeed capturing and documenting it. So many thanks for sharing your experiences with us. Nigel and Jules for a really clear description of the tool itself and how it should be used and how it can be used. I'm sure that we can. I'm getting thank yous on the chat line down here as well. So everyone's very grateful for what you've taught us today. I'll close with a word of thanks to Christian and Anne from the IAA, who are still awake at 2:30 a.m. in Toronto. So many thanks for their support during this and for making it all happen. It's been really exciting and interesting for me, as well as I'm sure for you. But above all, thank you everyone for signing in today and for taking part in our mini series of seminars. We look forward to the next time. We don't know what the next one will hold, but we'll be with you again, and we'll hope to provide you with something that's really useful and entertaining at the same time. Thanks again, everyone. Bye for now.